Glad to have you back. Now, the Finance Act 2020 was signed into law by President Muhammadu Buhari on December 31st, 2020, coming on the heels of the Finance Act 2019, which amended several tax statutes. Now, the act was enacted in furtherance of federal government's progressive reform of the business climate in Nigeria and the need to constantly restructure the tax system to align and conform to international best practices and make it respond effectively to the changing social economic landscape. Specifically, the Act amended 14 principal tax and tax-related legislation, one of which is the personal income tax. In the personal income tax, non-resident individuals, executor or trustee carries on a trade or business involving the provision of technical management, consultancy, or professional services to a person resident in Nigeria. The person resident in Nigeria, the profits occurring from such trade or business shall be deemed to be derived from and taxable in Nigeria. To that extent, that the individual executor or trustee has a significant economic presence in Nigeria. Low-income earners earning minimum wage or less are now completely exempted from the payment of personal income tax. Let's break it down, the ambiguity of this new law to an average Nigerian. I have live in the studio a senior manager of Anderson Tax, Mrs. Olayinka Oluwata. Thank you very much for your time, Mrs. Oluwata.
Thank you for having me.
It's great to have you on the show. First, I'll start this way. What are the introductions to Personal Income Tax Act that we need to be aware of, and Nigerians, of course?
Okay, so I'll start by talking about what Personal Income Tax Act is again, as you have earlier on mentioned. So Personal Income Tax Act covers the taxation of the income of individuals, estates, trustees, non-corporate entities in Nigeria. And then in computing these taxes, there are certain reliefs and allowances that is actually granted in the course of computing these taxes. Okay. Now, some of these allowances is a function of the gross income. And then they're also a function of perhaps a part of the gross income or total gross income. One of these is a consolidated relief allowance, also known as the CRA. Now, the CRA is actually computed as 200,000 naira plus 20% of gross income for income brackets below 20 million naira, and then also computed as 21% of gross income for income brackets above 20 million naira. Now, the definition of the gross income for tax purpose includes your income from all sources. So whether it is compensation, whether it is benefits in kind, all this form, or whether it's global, all your global income constitutes your gross income. And before now, it is on this basis that the CRA is computed. However, with the introductions in the Finance Act, they have kind of amended the gross income for CRA computation purpose. So basically, items such as tax-exempt items, like your pension contributions, your NHIS contributions, your NHF contributions, must be back out of the gross income. Okay. Items such as non-taxable income, like income that you derive from abroad and bring it in through government-approved channels, should be backed out of the gross income. Frank investment income should be backed out. And therefore, also for individuals that are self-employed, also their capital allowances and allowable expenses should also be backed out of the gross income. So what this implies is that before now, the CRA that you would have typically enjoyed is going to be reduced based on the change that has been made to the basis. So we expect now that your tax pay for this month, since the Act became effective on the 1st of January, the tax pay for this month is going to be higher, leading to a reduced net pay for employees. So employers should be well guided to kind of start to put this into consideration in computing the pay taxes for this month. And employees should be aware that it's most likely there's going to be a reduction in their net pay from January going forward. And like you rightly said, another introduction is the minimum wage. So income earners that earn minimum wage, you know, the national minimum wage now is 30,000 naira, and the annual value is 360,000 naira. So people that earn these income brackets are totally exempt, whether from minimum tax or from income tax. They're totally exempt. And I can also touch a bit on the non-resident individuals and entities that are operating in Nigeria. So before now, when a non-resident individual provides a service to a Nigerian resident, the service that they provided and the income that they earn from such service is taxable to the extent that such non-resident individuals have a fixed base in Nigeria. So basically, if they don't have a fixed base in Nigeria, that means they can render that service and then they will not be subjected to tax. However, with the new Finance Act, they have introduced, in addition to that, another check is that any non-resident individual or non-corporate entity that provides services in the line of technical management, consultancy, or professional services to any Nigerian resident, there's going to be a tax of withholding tax. There's going to be withholding tax on the payments, on the gains from such service. And the person to whom that has the obligation to deduct and remit that particular tax is the person that they're rendering the service to here in Nigeria. So organizations that actually employ the services of non-resident individuals should start to take note of this and should start to comply as applicable. Now, the law also talks about that these non-resident individuals will be taxable if they have a significant economic presence in Nigeria. However, the check in that regard is going to be done by the Minister of Finance in the terms that there's going to be an order that will be released to enable us check the activities of the non-resident individuals to see whether if they qualify as being residents in Nigeria. So until that law comes out, perhaps organizations that employ the services of these non-resident individuals should just take note and be aware that they have an additional obligation to deduct withholding tax. And even non-resident individuals that provide services to Nigerian organizations should also be aware that most likely the service that they render is going to be subject to tax in Nigeria.
Now, employers have certain obligations to fulfill, in relation to payment to their employees. That is really key. And even employees will be affected. You already said that. Can you shed more light on this?
Okay. As you know, employers are basically like an unpaid agent of the government. So the tax that is due on your remuneration, for example, should be deducted by the employer and remitted. So the employer has the obligation to compute it accurately. It's called payee tax. They have the obligation to compute it accurately and remit it timely. For payee tax, it's supposed to be remitted by the 10th of the following month of payments. In addition to that, they also have the obligation to remit social security contributions that the employee makes. Okay. But another additional obligation that they now have is in relation to the capital gains tax that is applicable on compensation for loss of office. So before now, when an individual receives compensation for loss of office for 10 million naira, it is totally exempt from capital gains tax. When it's above 10 million naira, it is taxable under Capital Gains Tax Act at 10%. Before now, we've seen several tax authorities try to tell companies, issue circulars to tell companies that you should deduct before making this payment. But because there is no express provision of this in the laws, there has always been a pushback. But with the Finance Act now, it has now been included in the law that employers should deduct 10% withholding 10% capital gains tax on compensation for loss of employment that is being paid to their employees. If the compensation is more than 10 million naira, that is.
That's a good one. Now, what do you think individuals now and, of course, businesses should start to do? Because, you need to manage tax exposures and, of course, increase their after-tax income. Okay,
so I would say that it cannot be overemphasized that we need to keep proper books and keep proper accounts. Because if you don't keep proper books of accounts, talk about companies, for instance, if you don't keep proper records, you're supposed to be taxed on your profits. And if there's no way for us to ascertain your profits, how are we going to tax you? So this typically leads to excessive prolonged audit, excessive scrutiny by the tax authorities. So when they try to keep proper books of accounts and records, it goes a long way in helping them to manage tax-related expenses. Another thing that employees also need to start to do is to kind of continue to look at the laws, look at the tax planning opportunities within the tax laws. There are still tax planning opportunities there. For example, you need to know that if you have a mortgage loan and you pay interest on a mortgage loan, you can actually take that as a relief. You need to know all these things. You need to keep abreast of the laws. Once you can keep abreast of the laws, you'll be able to manage your taxes as much as possible and improve your net pay.
Professionals like you that advise clients and all of that, with the challenges in 2021, how has it been? What have you been? What are the ways to go for business people and all of that, so that the tax doesn't eat up almost all our income for the year?
Yeah, well, I would say that, like they say, there are two certain things: debt and taxes. There's nothing we can do. We need to pay our quota. But the problem arises for you when you don't do it, because in addition to not paying it, you're still going to pay what you refuse to pay, and also pay additional penalties, and most likely pay additional interest on the unpaid taxes. So the bottom line is that companies, individuals, taxpayers in Nigeria need to be fully compliant with the tax laws. Try as much as possible to remit on time. Try as much as possible to pay on time, so that if at all you even have to pay taxes, you are just paying what is expected of you and nothing more than what is expected of you.
Some want to talk about automation. Maybe some of paying the taxes at times are too cumbersome, maybe the processes and all of that. How well are we also doing to automate it, to make it easier?
Well, I will say that the tax authorities are doing a lot of,
Indeed,
improvement in that regard now. I know of some tax stations, some tax authorities that now you can file your taxes online. You don't need to go to their office, you don't need to queue up.
Wow,
and
good.
then in addition, I'm also aware that now they keep records of, I'll call there's something that we call withholding taxes, which I believe you are aware of. So they're able to track withholding taxes now. And from withholding taxes is the tax that is withheld on an income that was paid to you. So when they have the value of all these withholding taxes, they can gross it up and use it to determine your income. So with all this, their technology, with the new process that they have better systems to track all this payment that is made to you, and they have better systems to actually determine the taxes, the income of individuals, income of taxpayers, and determine what taxes that they should pay.
Almost finally now, what more do you think Nigerians need to know about Personal Income Tax Act? I know you've touched on so many angles of it, but what more do you think we need to know that you are a professional in this field, what more do you think they need to know? And is there any way, because we always talk about improving our tax to GDP, getting more taxation, can we do this without making people feel uncomfortable? Some say we need to bring the informal people in. A lot of suggestions have come up so that you don't stress those of us that are paying. I pay tax.
Exactly. You're very correct. So presently, as you know, the tax to GDP rate is around 6%, which is really, really low compared to what the IMF has actually stipulated.
Yep.
IMF has stipulated that for developing countries, the tax to GDP ratio should be around 15%. Wow. Now, if you look at that, let's even break it down for the viewers. So if you say tax to GDP ratio, what exactly is tax to GDP ratio? It's basically a comparison of the output of a country in terms of domestic product to the tax receipts, the tax revenue that is generated by that company, by that country. So definitely, if you have so much GDP, you should expect to have so much tax revenue. You should be commensurate. And in looking at our figures, checking maybe the National Bureau of Statistics for 2020, second quarter, for example, they reported a GDP of about 38 trillion naira for Nigeria. Or now you expect that in that same period, if you look at 15% that has been stipulated, we expect that we have perhaps 5.2 trillion of taxes in second quarter of 2020. But the figures that we have based on statistics show that we had 1.2 or 1.3. That begs the question, where is the difference coming from? That tells us that there are actually some category of people that are not yet captured under the tax net. So basically, one of the things that I think, or that we believe that country needs to start to do, is to kind of focus on expanding the tax net. Because presently we have about, let's say, 77 million Nigeria, the labor force in Nigeria is about 77 million. And presently in that figure, we have only about 10 million that has registered for tax, that is paying taxes. So rather than, and this 10 million is the figure, the tax of this 10 million is the 6% that we have presently. So if you continue auditing, continue to pressure, continue to scrutinize this 10 million, we'll just move slightly above 6% perhaps. For us to actually achieve the figures that we want, we need to focus on those other people that are not in the tax net. We need to start to develop measures to bring them into the tax net. Something that can also be done is to kind of look at critically examine the GDP. So if you look at the GDP and look at the contributions of various sectors to the GDP, you will be able to tell, and then also look at the tax revenue of each sector. From that, we'll be able to know which sector is not contributing as much tax as they should. And then you'll be able to actually concentrate on this sector and channel resources to these sectors, and as such improve the tax to GDP ratio generally without having to burden or stress the people that are already in the tax net presently.
Well, you've heard it there from the senior manager, Anderson Tax, Mrs. Olayinka Oluwata. I must thank you very much there for sharing your expertise with us this afternoon on Business Nigeria. We hope to have you again when we're reviewing anything that has to do with taxation. We'll surely reach out to you. Thank you very much for spending your afternoon with us.
Thank you.
All right.